Welcome to today's explainer. Look, today we're bringing you a really smooth, solid, and complete daily financial briefing. We're going to take some incredibly complex macro data and map out these massive, dramatic sector rotations we've just seen hit the market. By the end of this, you're going to have a clear, actionable blueprint to navigate exactly what's happening out there right now.
All right, let's just glance at the agenda today. We're kicking off with macro data and Fed rates, moving right into fund rebalancing and volatility. Then we'll hit the chip versus software rotation, look at the real ROI of AI, and wrap it all up with trading discipline for low liquidity environments.
Okay, Section 1, Macro Data and Fed Rates. Let's get right into it.
200,000, that's the number. It's the Bloomberg Whisper estimate for the upcoming non-farm payrolls. Consensus might be leaning a bit lower, but this 200K figure, that's what institutions are quietly bracing for right now. It's signaling a labor market that is potentially overheated and honestly just refuses to cool down.
And this really captures the tension we're all feeling. Think about it. If we get a baseline print of around 115,000, okay, the markets breathe a massive sigh of relief. But what if that 200,000 whisper number actually prints? Well, that could severely damage any hopes for a September rate cut. We've actually already seen the implied probability of a September cut drop from a sure thing 100% down to, roughly 73%. A hot jobs report here could easily spike the 10-year yield and immediately pressure equities.
It's not all bad news, though. The latest May core PCE data held perfectly steady at 0.3%. So it's not plummeting, but hey, it's not accelerating either. When you look under the hood, the housing and rent components, which, let's face it, have been the absolute stickiest parts of inflation, they've actually notably cooled from their April peaks. So the Fed is really staring down this tight tug-of-war between a stubborn labor market and slowly easing housing costs.
Moving on to Section 2, Fund Rebalancing and Market Volatility.
Were you watching the tape on Friday? Because if you are, you might have felt a literal wave of panic. But let's break down the timeline. At 3:30 p.m., market trends were completely steady. Then at exactly 3:45 p.m., this massive capital rotation kicked off, culminating right at the 4 p.m. closing bell. So what looked like retail traders hitting the panic button on a Friday afternoon? Yeah, actually, that was a textbook, highly calculated institutional rebalancing mechanism. Massive pension funds were literally just reallocating capital, stripping profits away from their huge tech winners to meet their strict quarter-end requirements.
Context is absolutely crucial here. Sentiment indicators like the CNN Fear and Greed Index, they're screaming extreme fear. The headlines are panicking, but look at the actual data. Market breadth on the S&P 500 equal weight is mixed to positive. That means participation is broadening out beyond just the mega caps. And the VIX, the market's ultimate fear gauge, is sitting neutrally right around 18.4. So the data tells us there is no systemic panic right now. It's just structured mechanical rotation.
Which leads us nicely into Section 3, Chip versus Software Sector Rotation. Talk about a sudden divergence. The semiconductor index, the SOXX, absolutely tanked, dropping 7.7% for the week, heavily sold off during that Friday rebalancing window we just talked about. Meanwhile, the software sector, the IGV, bounced sharply by 3.44% on Friday alone. It actively absorbed all that rotated capital. It's like when one door closed in those crowded chip stocks, another one swung wide open in software.
And honestly, this semiconductor sell-off is kind of an incredibly healthy reset. The sector's forward PE ratio has rapidly cooled off from a dizzying peak of nearly 30 down to a much more rational 25.3. This is not a bubble bursting, guys. This is just valuations resetting to a level where investors can actually catch their breath, and where new buyers might finally find an attractive entry point.
All right, Section 4. Let's talk about the AI investment reality.
We are actively moving along a fascinating timeline here. Remember 2023? That was the FOMO era. Just maximize token usage at all costs, figure it out later. But now, as we stare down 2025 and 2026, we're entering a mature phase that is laser-focused on real-world ROI. Wall Street wants to see the receipts, and this reality check is perfectly illustrated by reports that OpenAI is delaying its IPO to 2027. Why? Because institutional investors are demanding a much closer look at their debt structures, their margin profiles, and all those massive off-balance sheet computing commitments.
The enterprise level is really feeling the pinch right now. and the irony is kind of striking. AI is actually becoming a cost-cutting burden for the exact companies trying to implement it. You've got major players like Coinbase actively adopting cheaper, open-source AI models for coding tasks just to get their computing costs under control. At the exact same time, infrastructure providers like AWS are aggressively jacking up cloud prices. Some reports have saying by up to 20% just to cover their own massive hardware and energy bills. The sheer cost of AI is finally hitting the bottom line. And it's definitely not just software. Hardware margins are getting squeezed globally by memory chip shortages. Apple is passing these costs directly on to consumers, and they're facing some of the highest product price hikes we've seen in 40 years for things like Macs and iPads. To fight back, Apple is reportedly lobbying to integrate cheaper Chinese memory chips, purely as a play to defend their supply chain margins. It's fascinating. When the bottom line is threatened, geopolitical friction quickly steps aside for strict cost reduction.
But hey, let's not lose the forest for the trees here. Despite these hardware constraints and all these software rotations, the fundamental outlook has not broken. There's an industry insight that beautifully captures this. AI will eventually return to an incremental logic. As the downstream pie grows, everyone gets a share. The long-term trajectory for AI remains an expanding, fundamentally sound economic pie. We are literally just dealing with the growing pains right now.
Okay, bringing it home with Section 5, Trading Discipline for Low Liquidity.
Right now, we are entering a low-liquidity, holiday-shortened week, so you have to adhere strictly to what not to do. Do not trap yourself by waiting for weak stocks to bounce before you raise your cash. Do not let event logic, holding out for some magic headline, override your strict stop losses. Do not trade aggressively into low volume, and absolutely do not mix your long-term foundational budget with your short-term trading capital.
Instead, here is your proactive playbook. Step 1. Sell out of your weak, non-core positions immediately. Step 2. Use any days of market strength to trim those rebounding stocks and actively harvest liquidity. And Step 3. Use those funds to lock in a 12 to 15% cash buffer in your portfolio. That cash buffer, that is your absolute armor against the macro shocks and volatile data prints we've been talking about today.
So, I'm going to leave you with this question to chew on. Are you surviving the volatility, or is your portfolio trapped in all the noise? As we navigate these upcoming macro data dumps and massive institutional rotations, make sure you are actually executing a disciplined strategy, not just reacting out of fear. Thanks so much for hanging out with me on this explainer. Stay disciplined out there, and I'll catch you next time.